Now let's look at non-financial indicators. Non-financial indicators. By non-financial, we don't mean there are no numbers. We just mean less of money targets. All right. So these are also called qualitative measures, qualitative targets. Examples include customer satisfaction measures. For example, you will need to look at customer retention, percentage of returning customers, percentage of new customers as a percentage of the total portfolio of customers that you have. All of those, that's customer satisfaction. So that is not related to money at all. That's a qualitative measure or a non-financial indicator. Another example is resource utilization, where you're looking at our machines operating at full capacity, things like idle time, breakdown time. That is looking at efficiency, your resource utilization. Are you using your resources at optimum level? Another example could be quality issues, quality measures. Now, how do you measure quality? For example, things like reworks that need to be done, returns, warranty claims, etc. All of those are measuring the quality of your product. You're measuring the quality of your product. Now, that is going to be very important. You want to increase your quality. You want to always increase your quality. You have to have a measure for your quality, and that will improve the bottom line in the long run. Another one is, for example, number of new products. In this highly competitive age we're living in, the more products you have, the more profits you stand to gain. Remember, companies are becoming multifaceted. Before, 10 years ago, some companies were just in one industry. Companies like Amazon, for example, when they started, they were all about selling online. Now they're into space businesses, they're now into manufacturing, delivery, they're using drones, they've all got all this virtual reality, now they have TV shows. So how many new products are you producing? That's a qualitative aspect that actually is going to affect the bottom line in the long term. So that is something that companies must look at. And then another example of a qualitative aspect is things like staff retention. You don't want to be that company where employees just come for a few months and they leave because they cannot stay there for whatever reason. The more staff that is leaving you, if you've got a high staff turnover, you're never going to get people who are actually settling down and become experts at what they do in your company. So that is actually bad for business. So things like staff retention should concern a company. These are examples of non-financial indicators that can be looked at. Now, there's a major tool that is generally used by companies whenever they want to come up with a mix of financial targets and non-financial targets. And this is what it's called, the balanced scorecard. The balanced scorecard. Now, at the balanced scorecard, we've got 4 perspectives, and each of those perspectives has its own targets. It has its own targets. So that's what we're going to be looking at next. So this is the balanced scorecard. This is what it looks like. It has 4 perspectives: the financial perspective, customer perspective, the learning and growth perspective, then finally it has the internal business process perspective, internal business process perspective. Okay, now we're going to look at the first one, which is the financial perspective. Now, under the financial perspective, this is where we're talking about our financial targets. Now, the question the company is asking themselves when it comes to the financial perspective is, to succeed financially, how should we appear to our shareholders? So you're asking yourself, what do shareholders expect from us? That's the financial aspect. So you're going to need to develop measures that can actually measure that, or targets that measure that aspect. So examples of targets that can be used are net margin, your gross margin, return on capital employed, return on investment, residual income. All of those measures, they are financial measures that can be used to come up with financial targets that measure your financial perspective. Now, it's only one. That financial perspective is the only financial one. The other 3 are qualitative aspects. The next one we'll look at is the customer perspective. Now, the question the company is asking itself is, to achieve our vision, how should we appear to our customers? Now it's customer focused. What do customers expect from us? That's the question you're asking. Now you need to have targets or measures that are aligned to that question. So examples of such measures could be number of customer complaints. If you've got an increasing number of customer complaints, then definitely you're not meeting your customer perspective targets. Definitely. There is no company that makes more money in the long term by increasing the customer complaints. So you need to deal with that. So that is a measure that's supposed to highlight where you stand in terms of the customer perspective. And another example is percentage of returning customers. Percentage of returning customers. Every company wants to retain customers. You can be very good at getting new customers, but if you're very bad at keeping them, then you're not going to be sustainable, because at some point you're going to run out of new customers. So you need to be able to retain customers. So that measure, that percentage of returning customers, is a very important measure. Now you find nowadays when you walk into many shops, they give you what they call customer loyalty cards. Another use of those cards is more than just giving you discounts when you have reached a certain number of sales or whatever. It actually helps them to track the percentage of returning customers. That's a way of using those cards for the customer perspective. Another example is looking at new customers as a percentage of the total. That's an example of a non-qualitative aspect under customer perspective. New customers as a percentage of the total portfolio of customers that you have. If you keep having more customers, higher numbers of new customers, that is good for your business. It improves the sustainability of that business. Okay. Now going to the third aspect, which is the learning and growth perspective. It's also called the innovation and learning perspective. So this focuses on the need for the continual improvement of existing products and processes and techniques, and developing new ones to meet customers' needs. Now, examples of measures that you have to develop to measure this perspective are percentage of revenue attributable to new products, for example. That is very important. Another one is time to market of a new product, the time to market of a new product. That's a very good measure. How long does it take you from the inception of a new product up until it's ready to be on the market? That's a very important measure right there. Because remember, we said modern business is highly competitive. While you're busy trying to perfect your product, somebody else has already undercut you and released their product. So your time to market is a very important measure. And then lastly, we're going to look at, for example, number of staff training days. We expect if staff are being trained more, then they're going to be more innovative, more efficient in whatever they're doing. So that's an internal measure that's very important. The last one is the internal business process perspective. Internal business process perspective. And you're asking yourself, to satisfy our shareholders and customers, what business processes must we excel at? You see now, you're asking yourself, to satisfy our shareholders and our customers, what business processes must we excel at? All right. Now, things that you can measure here are, for example, unit costs. Unit costs. Just looking at your unit costs. This is a measure of how well are you controlling your costs. Okay. Cost control is a critical success factor in every business. So just comparing your unit costs with other companies or with competitors, that is very important because it tells you where you stand. If your costs are too high, you're either going to be forced to increase your prices or to reduce your margins. Either way, you're affecting the shareholder maximization goal. Okay. Another one is capacity utilization. Capacity utilization. Capacity utilization is if you can manufacture 1,000 units a day, why would you produce 500 if the demand is there? So capacity utilization is simply looking at how well are you using your assets. How well are you using your assets to produce your output? If you can produce more to meet demand, then do it. If you can't, you need to identify why can you not meet the demand. Is it because you're not using your capacity fully or you just don't have the capacity? So if it's a matter of you not being able to use your capacity fully, then you can do something about it. You need to measure it first for you to identify that there's actually a problem there. And then last example we'll look at is number of units rejected. Number of units rejected. If you have a high number of units rejected, then somewhere along your process, something is going wrong. Either your whole process is substandard or some part of the process is malfunctioning. Something is not going right there. So whether it's because you've got untrained people or it's the material that is coming that is defective, whatever it is, you need to find it out. So you must have a measure which measures that aspect to see how many defective products are we producing. And you need to get to a point where your defective products are in the range of 1 in a million. That is a good sign. Not when you have, out of 100, you've got 20 defective products. That 20% is too high. But you must measure it first for you to identify that there's actually a problem there. So that is the use of the balance scorecard. It tries to balance out all the necessary perspectives that you need to look at for your business to be profitable and for it to be sustainable for the foreseeable future. So that is the balanced scorecard. So now let's look at service industries. Service industries. So many organizations can be categorized according to the following categories. Generally, they're manufacturing industry, or they're in the service industry, or maybe they're non-profit making organizations, in which case you can't put them whether in service or manufacturing. Okay. Now, for those that are profit making, it's usually they're in manufacturing or they're a service industry. Okay. Now, the goals of these organizations, they will differ because of the industry that they operate in. All right. So the goals in a service industry tend more to be aligned with quality rather than the goals of organizations in manufacturing, whose goals are mostly to do with reducing costs and maximizing contribution. Now, most of the discussion we've had so far has been about mostly manufacturing industry companies. Now we're going to change and look at the service sector as a whole. Okay. Now, generally, as economies develop, we've discovered that you get, the more an economy develops, the more the service industry companies start developing. And so fully grown economies will usually have more service industry companies than manufacturing companies. So that means the bulk of your companies or your organization in a developed economy will be service companies. And so how do we then deal with the costing of it, the performance management of it? All right. So now, examples of service sector companies include banks, audit companies, consultancy firms, hospitals, airlines, hotels, all of those where you really can't touch the service, but they do provide a service. All right. So this is what we're going now to be looking at, the service industries and how performance measurement can be done in these industries. Now, service industries, they have certain features that identify them. There are certain features that identify service industries. For example, intangibility. That's the first one, intangibility. The service cannot be packaged and stored away, neither can the customer carry the service away with them. So they just receive your service, they experience it, but they cannot take it away except as a memory. That's it. So the product is generally not physical. You cannot touch it. You cannot take it with you. That's intangibility. The next factor or the next feature is variability. Variability. The services tend to be different one from another. When you go to provide an advertising service to a customer, the service you're providing for one customer is not exactly the same as the service you're providing for the next customer. They all want slightly different things. So you don't have a standard service to provide. You provide a service as required by the customer. So each service is generally unique and it differs from the next one. So standardized service is rare. That's in the service sector. You have to differentiate your services every time. Okay. The next feature for service industry is that there is simultaneous production and consumption. As you deliver the service, they experience the service. It's not like you provide your service now, you package it, then you give it to them and they'll experience it later. So if you're in auditing, as you are auditing, that is providing the service. That is providing the service. If you are a doctor, a nurse, and you're working in a hospital, as you are administering treatment to that patient, they are receiving the treatment at the same time. So it's simultaneous. There is no difference between the time when you provide the service and when they'll actually enjoy the service. And then the last feature is perishability. Remember, services cannot be stored for later. Once you've provided a service, you have provided it. You can't store it for later. So, for example, if you've got an empty seat in an airline, they can't take that empty seat and say, we're going to sell it again tomorrow. Tomorrow is a different day. Today, it was an empty seat, and that is it. Okay? An empty hotel room cannot be stored for later use. So, in service industries, capacity utilization is very important. They pay particular attention to capacity utilization because you want to utilize it as much as possible so that you can maximize your returns. That's those are the features of services: intangibility, variability, simultaneity, and perishability. So how then do we calculate unit costs for services? You see, for manufacturing, it's easy. You know how to do marginal costing. We know how to do traditional absorption costing to come up with the cost of a unit. Now, how are you going to come up with the cost per unit or per service or in service industries? The unit costs are rather complicated. Okay, now coming up with suitable cost units for services is fairly complicated because the service is not tangible and cannot be easily quantified. Okay, so composite cost units, this is where they come in. If you remember when we looked at cost analysis in our earlier chapters, we looked at what we called composite cost units, which is a cost unit that has more than one unit measurement in it. Okay, so this is where they come in handy. For example, in a hotel, they would have per room per night. You would pay an amount per room per night. That is a composite cost unit, which is combining room and night. Those two different measurements are combined to give you one measure. In hospitals, they would have an inpatient day. So it has something to do with a patient and the number of days they spend in the hospital. That is an example of a composite cost unit. If you're a haulage contractor, maybe you'd use something like a ton kilometer to say how much are you going to charge per ton per kilometer, for example. So those are examples of composite cost units. Airlines generally use what they call passenger miles. All right. Now, to calculate it, now that you've identified your cost, your composite cost unit, to calculate it, you're simply going to say the average cost per unit of service. It's going to be an average, since we said there's rarely ever any standardized service. So what you're going to calculate is an average of some sort. And so the average cost per unit of service is going to be calculated by total cost incurred for the period, the total cost for providing that service to all your customers, divided by the number of units of service that you supplied in that period. Okay, the total cost incurred in the period divided by the number of units of service provided in the period. That's how you calculate the cost per unit of service, whatever that unit is. So let's look at an example. Records for a passenger limousine company reveal the following data for last period. So it has a row listing the number of passengers and the number of miles that they traveled. So we have a total of number of 80 passengers who traveled 4 miles, 40 passengers who traveled 5, 90 passengers who traveled 6, and so on up until 150 passengers who traveled 10 miles. The driver's wages cost incurred was 1,100. That was the amount paid for the drivers for fetching all these customers. Calculate the driver's wages cost per passenger mile to the nearest cent. The driver's wages cost per passenger mile to the nearest cent. Now, the solution is we simply added one extra row to that table where we're now calculating the total passenger miles for every trip. Now, the total passenger miles for the first row, we simply said 80 passengers traveling 4 miles, so the total passenger miles were 320. For 40 passengers traveling 5 miles, the total number of passenger miles were 200. Then we did the same for all the number of miles traveled from 4, 5, 6, 7, 8, 9, and 10. And then the total passenger miles in the last row add up to 6,000. Those are the total passenger miles. Now, since passenger mile is your unit cost, it's your unit cost. To find, therefore, the cost per unit, we simply say the total cost, which is the wages, the driver's wages cost of 1,100, divided by that total number of passenger miles, which is 6,000, to give us 18 cents per passenger mile. It's 18 cents per passenger mile. So if a driver wants to find out how much he's going to get paid, he just needs to calculate how many passenger miles did he cover. How many passengers did he carry and how many miles did they take? You multiply the two to get your passenger miles, and then you multiply by 0.18 to get your answer in dollars. That's how it's going to be done. So the calculations are relatively easy, but please understand the words that you're using. That 18 cents, it's 18 cents per passenger mile, because passenger miles, that is your unit. All right. Now we want to measure the financial performance in service industries. Remember, this chapter is called performance measurement. So how do you measure performance in a service industry? So far we have looked at performance measurement in a manufacturing environment. Now in a service industry, all those financial ratios we calculated, they still apply, though to differing extents. So you can still calculate your gross revenue, you can still calculate your revenue per service, staff costs as a percentage of revenue, training costs as a percentage of revenue, your net margin or revenue per partner in partnerships, whether it's accounting companies or consultancy firms, where you can calculate your revenue per partner. In other companies where they deal with sales, for example, every salesperson would actually be appraised on the basis of revenue made in the year. They can actually keep a track record of how much revenue you have made since you started working for them up to date. All right, and then they can measure revenue as total revenue, your percentage of revenue gained every year. So they all differ according to your specific conditions or your specific situations, but you can still calculate all those general ones. Now, financial ratio analysis will be of limited use due to the human nature of service provision. Okay, the service is usually a human providing a certain service. Now, to come up with a standard where a human is doing something different every time may be a problem. So financial ratios may not give you the full information that you need. So for that reason, there are also quality issues or non-financial performance measures. So let's look at the service quality. Okay, quality of service is going to be the key point whether customers choose you or they choose a competitor. It's usually a matter of quality. All right, so quality is a critical factor in service industries. Customer satisfaction is key. It's all about what the customer wants and what the customer perceives your service to be. All right, now suitable measures for a hotel, for example, could be length of time at a reception. Nobody wants to walk into a hotel and have to wait for an hour before you're served. Okay, no matter how busy they are, nobody appreciates that. So the length of time at reception is actually a measure of quality. If you've got a longer time than your competitors, then you know how people are going to feel about your service. And another example could be the hotel facilities themselves, the quality of the hotel facilities themselves. Some hotels offer buffet for breakfast and dinner. Some are just minimalistic, they just provide the room and all of that. That is actually going to impact your rating. So you need to look at that. Another measure could be cleanliness of the rooms or food quality or helpfulness of staff. Now, all this information can be gathered usually from customer comment cards, customer feedback cards, where when the customer is leaving, you give them a card to fill out, then they drop it in a box, a suggestion box or something, and then you read them to see how customers feel about you. Those are quality issues, non-financial issues that are very important in service industries. Now, every service will have different measures to address their particular situation. The measures used in a hotel cannot be the same measures used in an airline. An airline will have other uses, other measures that they need to come up with. All right. So this is just the overview in terms of services. So we've come to the end of our chapter on performance management. We've looked at performance measures, both financial and non-financial for manufacturing companies, and we've looked at financial and non-financial measures for service companies.